The first thing you want to be doing is to identify the overall trend direction of the market. Basically, what we must know in this step is who is in control of this market, buyers or sellers. And after we find out, we just look to position ourselves with the ones that are in control. But for that, we must first analyze the direction of this market. And we do that starting from the very beginning, on the left of the market, from the very first candle. And with the directional analysis, we connect each swing low to each swing high, and each swing high to each swing low. This directional analysis of the price makes the swing points more visible. The swing points are the highs and lows of a market. For example, at the beginning of this market, we start from a swing low that was followed with some upside action, which created a high. From this high, price pulls down into forming a low, and this low is higher than the previous low, and that means that this recent low is a higher low swing point. The higher low is a swing point of an uptrend, but the uptrend is not confirmed until the market also has a swing point of a higher high. And in this case, that's exactly what happened, because from this higher low, the price is pushing back up and breaking above the previous high. A break above the last high is what we call it as a break of structure. The break of structure says two important things. One is that if the market broke above the last high, that means that we got a higher high swing point. And the second thing the break of structure says is that after a higher high is printed on the chart, a higher low should be the next swing point, and that's because the market has basically confirmed an uptrend. The confirmation came after having two coupled uptrend swing points. So basically the higher low, which was then followed with a higher high. So now we basically expect an uptrend. And why is that? Because we don't look to trade against the trend, we just analyze the trend's direction, and we position ourselves with that trend. We don't expect a reversal without the market giving any sign of it. And so if we expect uptrend continuation, that means that after a higher high, we look for a higher low. And that higher low is a downside pullback that can't break the last low, but it must end above the last low. The level it will often end is on a demand, and that demand is found on the previous low. And that demand level is the last downside candle before the price started pushing up. But in this case, we see that this demand did not fill. The price has pulled back down so it can look for a swing low. But that swing low didn't end on the demand, but it actually ended above it. This is completely normal. Not every demand will fill or even respect, but it's still very important to notice them and properly read the price action, because eventually one or another will fill and work out well, and you must be able to have noticed that opportunity. But in this case, it's still fine since the price still ended above the last low, so it has kept the swing points that we care about, and that is a higher low. And after this higher low, the price started pushing higher and higher, this of course breaking above the last high. The break above the last high on an uptrend is a break of structure, and this break of structure happens when the market has formed a higher high swing point. And after a higher high, if we look for uptrend continuation, we look for a higher low, and that higher low on an uptrend should sometimes or often end on a demand. That demand is taken from the previous low, and more specifically, that demand is the last downside candle before the price started the upside impulse, with that impulse being the push that broke above the last high. And this time, this demand has respected, since we can see that from the higher high, the price fell down to find a low, and that low has ended right inside of the demand level. So it has kept another uptrend swing point of a higher low. These demand levels are not just sitting there for nothing. They are levels that can give great buying setups. For example, from a demand level, a buy setup would be placed with an entry on the top of the demand, with the stop loss below the last low, and take profit above the last high, looking to target at least a 1-to-2 ratio. And this setup would have closed on the take profit right here. So our goal is to read the price action, so we can find these type of setups. And to find these type of setups, we need to finish the analysis in the first place. So from this last higher low, the price created this upside impulse, and the important part is that it breaks above the last high. And so that's a break of structure above the last high, which means that we have another higher high swing point. And after a higher high, on an uptrend, we need to look for a higher low swing point. And that higher low will often end on a demand. Demand that's taken from the previous low. And to be exact, that demand is the last downside candle before the price started pushing up, with that push being that price action that caused the break above the last high. And we see that the next downside pullback has again hit and respected this new demand, ending on a higher low swing point, and again, if we test a setup from this demand with the same entry logic, being on the top of the new demand, and the same stop loss logic, being below the last low, and with the same take profit logic, being above the last high, but in such a way to at least target 1-to-2 ratio. And we notice how this also ended quite similar, closing on the take profit right here. But what we care about is what caused the market to close on the take profit target. Well, that's because after the price hit the demand, it bounced to the upside, having this upside momentum that is broken above the last high. And a break above the last high is a break of structure. And a break of structure shows that we got a higher high swing point, and after a higher high on an uptrend, the market will look for a pullback so it can find a swing low. That swing low will often end on a demand taken from the previous low. Demand, that's the last downside candle before the price started pushing up. And in this case, we also see that the pullback didn't manage to hit into the demand, it actually ended way above it, before continuing the uptrend by pushing up and breaking above the last high, so having a break of structure. And this is created because we got a higher high. And after a higher high, we look for a pullback to the downside to find a swing low that on an uptrend should be a higher low. But now that uptrend pattern has stopped forming, since we see that after having formed the last higher high, the price fell down aggressively. So if we were looking for a demand from the previous low, that demand got broken down. The market basically invalidated the demand, and that means that a buying setup would have ended as a loss setup. But don't be too worried about lost or missed setups. As you've seen, we had this demand where it didn't even fill, and this one as well. And now we've got this last buy setup that ended on a losing position. But a new movement will bring a new opportunity, and in this situation, if the demand broke down, that also means that the price is broken below the previous low. So this is no longer a break of structure. This is a trend change. And why is it a trend change? Because if we look at the last low, which was a higher low, that's a swing point of an uptrend. But now price has eventually broken down below the last low. So if the new low has ended lower than the last one, that means that we finally have the first lower low swing point, and a lower low is a swing point that's met on downtrends, which should be followed with lower highs. A lower high, as it says from its name, is a high that ends lower than the previous high, and that translated into the market is a pullback to the upside that must end below the last high before it continues the downtrend by pushing down and breaking below the last low. Because as I said, on a downtrend we should be expecting swing points of a lower high, followed with a lower low, and this pattern repeated constantly is what actually is a downtrend. On a downtrend we stop looking for demand levels, so it makes no sense to identify and trade demand levels. And so we invalidate this one that broke down and the one from below, since it's likely to also break down. And now instead of identifying demand levels, we look for supply levels. And they are found on the highs, on the last highs, to be more exact, it's the last upside candle before the price started pushing down. So we look at the last upside candle, which should be this one. This being a supply taken from the last high. They are exactly the opposite of the demand levels, meaning that we don't buy from these levels, but we sell from them. The planning of the setup starts with the entry being placed on the bottom of the supply, basically right when the price gets to hit the supply. The stop loss is being placed above the last high, in an expectation that since we're on a downtrend, we shouldn't see a higher high swing point, but we expect the next high to end below the last high. So we want a lower high swing point. It's what happens on downtrends, having lower highs that are then followed with lower lows. So this also told you where the take profit target is being placed, and that's below the last low. So from this last lower low, the price pulls back, as expected, and soon after it has hit the supply, the price begins to push back down quite aggressively. So after it has hit the supply, every single candle after that was closing bearish. This kept going until eventually the price broke below the last low. So it kept the swing points of a downtrend, which they are a lower high, being the pullback that ended on the supply, that was then followed with a push to the downside that broke below the previous low. And now the break of structure is to the downside. It's a bearish break of structure, and that shows that we got a lower low swing point, and it's this lower low that caused the sell setup to end on the take profit target. Now what we are looking for is trend continuation. As I said in the beginning, we analyze the price action so we can know the direction of the market and the trend that it's following. Because all we want is to be positioned with the trend, and that trend in this case is a downtrend. And on a downtrend after a lower low, a lower high would be the next swing point. That's the expectation if we want this downtrend to continue, and we don't look for any reversal, or we don't trade against the trend until the market actually creates the reversal. And until then, we just follow what the market has been doing. So a lower high is an upside pullback that must end below the last high, so it can then continue the downtrend with a lower low swing point. So basically a break below the last low. That lower high should end on a supply taken from the last high. And to be more exact, the supply is the last upside candle before the market started the downside impulse. And that's exactly this candle. And as I said, from supply levels, we look for selling positions. With the entry placed on the bottom of the supply, the stop loss is placed above the last high. And we see that with this placement, the stop loss is quite wide this time. But that doesn't matter that much, since we still look for a similar risk-reward ratio, which that means that the take profit will also be wide, and moving into the take profit target, which should be placed below the last low, but as I said, targeting at least a 1-to-2 ratio. And we got a similar pattern, the price having a pullback to the upside, which hit the supply, opening the setup, and of course ending on a lower high swing point from where the market pushes back down, basically rejecting from the supply into breaking the last low. So if it breaks below the last low, that means that we got a lower low swing point, which is the swing point that closed this sell setup on the take profit. Now I highly suggest you watch the pinned video as well, because that's where we get in depth into the internal price action, something we didn't get into today's video. And you also have my program on the description if you want to take a look at it, but until then, have a great trading week ahead.